So we're back. It's a special episode because we do have the person that pioneered the first Dragon interview that we did. We're sitting down again with Ashvin Murthy from AVM Global Opportunity to catch up on his latest thoughts as we basically kind of go towards the tail end of the first quarter of 2021. We hope you enjoyed this interview as much as we had fun doing it. Ashvin, welcome back.
Nice to be back.
Exactly, man. There's so much. Obviously, when we did our first foundation piece, it was like October last year. And it feels like we've almost had 2 years in just that kind of period because it was pre-elections and pre-everything that we've seen kind of play out. You nailed a lot of things from a big picture perspective and obviously keen to find out what's top of mind. But maybe we can break it up in the sense of snapshot from when we last spoke. How you and the team did for the rest of 2020. Obviously, what was exceptional last year was you guys were profitable for the first 5 months, so including the bull in Jan and the big sell-offs in February and March, and then also still managed to get the turn in the market. So it'd be interesting to see how the year kind of finished. Then maybe second segment, we can go on to 2021, year to date. I do know you had some high conviction views that unfortunately have already started to play out, but there's potentially more tailwind. And then maybe we can close with, kind of bigger picture thoughts for the rest of the year, maybe even some scenario kind of, planning as well. How's that sound?
Sounds good.
Awesome. So tell me, snapshot last year, how did everything kind of close in essence?
So I think we last spoke end of Q3. Q4 was good. We ended off on a good note. So end of the year, we were up about 11.5%. We maintained a low volatility of about 5.5%. So we still kept the sharp above 2.
Nice.
It was very similar to 2019, but very different markets in terms of performance.
Yeah.
It was quite nice to see that the fund did well in a very high vol environment compared. 2019 was pretty high vol, but 2020 was crazy vol.
Yeah.
And it's been through all the different regimes now. And somehow we've managed to keep it at a 5.5 vol. So quite glad the strategy is nimble enough to get through this.
Gotcha. Yeah.
That was our 10th straight quarter of positive returns. 2021 so far is looking okay.
Okay.
Right?
Okay.
So I think, last year was an interesting market, that whenever you have a downturn, there's a lot of life support that's given to a market. Either it's monetary stimulus, it's fiscal stimulus. And that's where you get a bit of animal spirits. People just keep throwing money into stocks or anything because the liquidity just pushes asset prices up.
Yeah.
And now we're going to 2021. It's the transition.
Yeah.
So I think it's going to be an interesting market this year. A bit more volatile, not so clear cut.
Yeah, a little bit more noise, less signal, let's say compared to kind of last year, right?
Right. Only because people hate transition, right? And so when you go from one regime to the other, most people are not ready for it. And that's why there's a lot of volatility as people have to change their portfolio allocations.
Okay. So if you're going back to kind of 2020, what did you guys finish on for the year? And how would you even characterize kind of 2020 by the way you kind of think of it? Because going back to your point, it's almost like we saw 3, maybe some could even argue 4 different regimes in 2020.
Yeah, it was incredible, right? You had a mega bull market, a bear market, a bull market,
yeah.
And even in an interest rate regime changed pretty quickly.
Yeah.
So it's probably the quickest cycle we've ever seen.
And from a cross-asset perspective as well, literally every asset class moved, and that's not always sometimes the case, right?
Exactly.
Yeah.
You went through a full economic cycle, so to say, in the capital markets within 12 months. And I can understand that because it was a pandemic. No one had planned for it.
Yeah.
It was a black swan event. I think the regulators, the central banks, etc., the governments came in to support the markets, and that's why they've done a good job.
Yeah.
Right. I think the coordination was pretty good, and so we've recovered quite well. And it's amazing how fast we came out with a vaccine.
Yeah.
Right.
Yeah,
it's all very optimistic. We're all very positive, and just goes to show you how good, never underestimate what can be done.
Yeah, I think if there's any takeaway I have from 2020, apart from obviously realizing how little I understand after being in the markets for plus 16 years, is anything is possible, right? That's for sure. And yeah, I think the vaccine also, to me, sometimes you have these pivotal dates. So last year, obviously, when the news finally broke in Italy, then the rest of the world started to take the news seriously. Obviously, April, March, the underwriting of the bond market by the Fed. And then I guess it was November 9th, the vaccine announcement, like Monday, right? Funnily enough, after the U.S. elections, interestingly enough. No, coincidence, I'm sure,
Yeah.
coincidence. And you've been running now, since November 2016, right? Yeah. How much has the fund done since then? You mentioned you guys still have a Sharp of 2. Like, what's been the overall total return?
Total returns right now are getting close to 50%.
Close to 50, okay. And you had a really good February when a lot of people actually struggled as well, right?
This year?
Yeah.
Yeah, I mean, this year was a bit tough, as we were talking about that transition.
Yeah.
So for me, coming into 2021, I think that what I noticed was, that's the beauty of doing cross-asset.
Yeah.
Right? You look at it from a top-down view, and I saw commodities were super optimistic, pricing in a post-COVID world, which is amazing. Equities doing the same.
Yeah.
Multiples at pretty high levels. And then you look at the bond market, and it's pricing in an economy on life support, right?
There was still like 90 basis points, 80 something, right?
That's correct. Right? And no hikes priced until 2024, that kind of thing. And you're thinking about it. So how does that make sense? How could you have equities and commodities saying that things are going to be great?
Yeah.
And the fixed income market thinking like, market's going to be tough, right? The economy's going to struggle over the next couple of years. So, I looked at my data, looked at what was going on, trends in growth, trends in corporate profits. And it occurred to me that there was a good chance if this vaccine rollout went well, that the US could grow at 8 to 10% this year, much higher than what everyone was expecting.
Yeah, yeah.
But even if it grew at 6%, that's huge.
And
right?
we just did 4, right?
We just did 4, yeah.
Yeah.
So, I think, so it looked mispriced. So, I think that's for me is what I tried to look for.
Yeah.
These transition periods is where you can make a lot of alpha.
Yeah.
Right. So for me, last year was that February, March period where there was a lot of alpha, just being ahead of that, right? Yeah. And I think this year was just being, looking at that and seeing that rates were too low. We had real yields at -1% when, it's expected that earnings in the S&P are going to be at all-time highs by mid-year.
Yeah.
U.S. growth is going to be, the growth rate this year is probably going to be somewhere one of the second or third highest we've seen ever.
Yeah. The Dems control the Senate.
Right?
Yeah.
So, so we went in, it was pretty much constructive on risk, but finding the best asset to express that opinion. And so we were short bonds, short gold, short tips, right? Because these things were mispriced. And the way I look at it, if I'm wrong, I don't lose that much money. If I'm right, there's a lot of alpha.
Yeah.
Right.
Yeah.
And alongside, we had some long commodities, long Asian stocks, just going with the theme of the recovery. And so, that helped us in January and February. So we were up about 3.5%.
Yeah.
And, starting March, it's still pretty volatile. We're up another %.
Yeah.
Just keeping that thematic because, I believe that transition period is tough and this repricing happens pretty quickly in the initial stages. So, we've had yields back up by 50 to 100 basis points, depending on which developed market you're looking at.
Yeah, it's huge. And I don't know if you can lend some context to that, because I think for a lot of people who maybe don't really look at bonds or look at yields or rates, we went from, high 80s, low 90 basis points on US 10s to like 160, right? In the space of a few weeks. How rare is that, right? I'm assuming it's a few times a decade at most, right? Maybe a handful, right? From that kind of context. And what's your view basically now where we're sitting? Because I don't know if you agree with me, but we were out for drinks a few nights back with a few folks. It got a little bit heated. And by that I mean it got heated from my side, having a discussion with also another very good friend of us, another beautiful mind. And it feels like right now, at least from a macro perspective, there's this question of, are we going to see YCC or are we not going to see YCC? Because obviously those probably have very different positioning consequences on one's portfolio, so to speak, right? Also from an asset class perspective. So, very, very simply, if we were to get YCC tomorrow, you probably want to back the truck up and pick up precious metals, right?
Yeah.
But if definitely we're never going to get it, precious metals probably have more to go, especially on gold. Maybe we could go from, this 1,700 levels to 1,500, right? Something like that. So, first of all, do you even really think or agree that seems to be where the market is very much focused on now? And what are your overall thoughts And I guess it's also a side way of saying, can we see more of an extension of what you've correctly predicted so far?
Yeah, I think we've had a big move in yields, right? It's gone to 1.6%. But what I try to focus on is the real rate of interest, right? The real yields. And so that's looking at the 10-year yield, for example, minus the 10-year inflation expectations.
Okay.
That's still at minus 0.65% roughly right now. Before the pandemic, it was 0. You have an economy growing pretty quickly, potentially this year, and corporate profits rebounding. It just seems too low still, right? So I think that is still room to run. I expect that to probably rise towards 0 by the end of this year.
Okay.
Which is still a very big move.
Yeah, exactly.
Right.
And what was the high? -1, you saying that we got to, or?
Minus 1.1.
Minus 1.1, right? So, okay. And now we're minus 60, right?
Yeah.
Basis points, right?
But in terms of before I actually look at a path, I like to take a step back and try and figure out where I think this will land eventually.
Correct.
At the peak of the...
What's kind of the equilibrium?
Right. And so real interest rates peaked at about 1% in the last cycle.
Yeah.
And then after this pandemic, we've had an explosion in debt. Generally, when there's more debt outstanding out there, you expect a lower rate of expected returns. So that I think the real rate will probably top out somewhere between 0 and 0.5% this time, as opposed to 1%.
Okay,
right.
So still positive territory, but not going back to the previous highs. Basically.
That's right.
Yeah, and that 1%. When did we do that? That's like 2017? 2018. Yeah, because it's much farther back than most people may have guessed, right?
That's right.
Yeah.
So I think with that in mind, is say if you look at inflation expectations, people are talking about the roaring 20s, commodity super cycle. So in the early 2000s, when China was opening up and China was buying a lot of commodities, you had inflation expectations peak out at about 2.7%.
Yeah.
I'm not sure we're going to get there this time, but assuming we even get to 2.7%, right, and real rates say get to 0, that tells me that 10-year yields are going to top out probably around 2.75, right? That's a rough gauge.
2.75.
At the peak of this cycle,
the
right?
Peak of this
I
cycle,
think that's as opposed to 3.25, 3.3 the last time around.
Gotcha.
So everything may be 0.5% lower. Okay, just that in mind. So how do we get there?
Yeah.
And I think at the end of this year, assuming the Fed, doesn't go. I mean, unless they want to let the economy overheat, I would imagine real yields should be getting closer to 0.
Yeah.
Doesn't mean they have to hike, but I think real yields get back to 0. And that's still very healthy for stocks. It doesn't, real yields at 0 and, growth is there, earnings are exploding. Sure. It's fine.
Sure.
So it's just this transition period where people are moving from one allocation to the other. That's creating a lot of vol.
Yeah.
And, creating a lot of people just unclear why it's happening.
Yeah, exactly. Because again, it's been such a linear, clear signal directionally from in one area, right? And now we're going into some dispersion, so to speak. And going back on that point, right? Good for stocks overall as an asset class, but also as you and I know, you don't mistake the standard deviation for the variance between the kind of the different sectors.
Right.
Do you have any thoughts in regards to some of the different sectors? Because I'm assuming, at least from a textbook perspective, yields going up. We've had financials finally starting to break out, right? And then obviously all the other stuff like utilities have kind of gotten smacked, consumer kind of staples and so on and so forth. So is there anything maybe kind of interesting there from a positioning-wise kind of sector perspective? Or is it just from you just look at kind of the broader index and try not to get too nuanced there?
I think from a sector perspective, you've kind of seen a lot of, the story stocks, the growth stocks.
Growth to value kind of, yeah.
Yeah, and especially all these companies which are trading at very high multiples based on big growth projections, right?
Yeah.
Right. The stocks everyone loves to own right now.
Yeah.
So they've been sliding a little bit. They're still, with these stocks, it's a bit tricky because there's no anchor to it. There's no earnings yet. They're trading on like 50 times sales.
Sure.
Right. So you just need enough demand to keep these guys going.
The animal spirits roaring, right?
Yeah. And that gets a bit tougher as companies start to actually make real returns and start paying dividends and interest rates go up. All right. I think they become less attractive when you're in a space like last year where there were no earnings, everything was terrible, but there's so much liquidity in the markets. You end up buying lots of stuff you shouldn't be buying. Yeah. Like Hertz last year, right?
Yeah, that did 5x in, I don't know, the space of a week or maybe even less, yeah.
But as real returns start to go up,
yeah,
you start to look for stuff that is probably going to make money.
Would you also think like that we're moving from a regime where, again, it could just be kind of high beta and jump on, and now fundamentals are going to come back to be a little much more important than, let's say, just pure kind of liquidity? Is that maybe a way of thinking about it? Or
Yeah, I think that's a good way of thinking about it. And also because as interest rates go up, you take a bit of froth out of the market.
Correct.
And that's very healthy. So I like what I'm seeing right now.
Yeah.
And I think by the end of Q2, we're setting up to a good bull market. We're based on good fundamentals.
Yeah.
Right. And that's when I expect the volatility to come down. A lot of people are confused why the VIX is still at 25, 26, and why it trades like that. It's because there's a lot of exposure to frothy parts of the market, and those are really volatile and they affect everything.
Yeah.
So this transition period, I would imagine the allocations that are frothy parts of the market will reduce, and they'll go into strong fundamental parts of the market. Like I like industrials a lot.
Yeah.
Because with global PMIs going up, GDP growth improving, that's a sound place to be.
Yeah.
Right. Some people have asked me about the big tech mega cap. I actually think after a period of repricing, they're going to do very well again. Yeah. Because if GDP growth is really at 8%, these guys are going to benefit.
Yeah, it's hard for them not to, right? It really, really is. Because I mean, obviously there's a lot of different names, but on all the big ones, there's real earnings, there's real businesses there, right?
Good balance sheet.
Yeah, yeah. And do you think of that as in maybe they got to pull back 30% from the top, or do you think it's also a combination, maybe a period of consolidation, or going back to try and just quantify your thoughts on repricing? Well, what does that exactly kind of mean?
Yeah, so I think yields, they've gone up, so they're 160 now.
Yeah.
You could go up a little bit more. I think that big 70 bips in a month move is done.
Yeah.
Right. That's when you clean. People get taken out of certain positions.
Yeah.
The next period in Q2, which I am expecting, is I think people are underestimating how fast unemployment's going to drop.
Gotcha.
Right? Because as they open up and this vaccination drive is going well so far, you'll see a lot more people go into the sectors that were severely impacted.
Yeah.
Right?
Yeah.
Businesses open up, people come back to work. So I think unemployment's going to come down and inflation prints are going to be strong. Yeah. Right? People expect it, but when they see it, I think...
Yeah, and low base effects as well, right?
Correct, yeah.
Right. Yeah.
So I think there's a period where the long end of the curve, so based on my view, is like, say 275 is the highs, right?
Yeah.
So the 30 years are already at 235, say.
Yeah.
So maybe that moves, but that's not going to really hurt you. Where I see stuff moving still is the front end of the curve.
Yeah.
Where people start thinking, hey, wait a minute, maybe they will hike in 2022.
Yeah.
All right, that's where people are still not prepared. I still have, I think that's a trade still has room to run.
Yeah. Okay. So, I would love to get some of your thoughts on EM, but maybe let's just quote unquote wrap up in regards to kind of the US, touch on maybe any other comments you have to add on fiscal policy. We obviously have 1.9 at the moment that has been passed from the House, and it's going to go to the Senate, I believe 14th of March is the date that I've seen. And I think there's also a key risk that it's not a slam dunk, right? Because they need all the Dems on board, right? And we've already had 2 renegade Dems in the House. But I guess, I don't know if you have a comment specifically on that vote and that bill, but what are your thoughts in regards to more fiscal in the US? Bearing in mind that obviously it's politicians, but Biden and Harris did campaign on $7 trillion of green tech, right? The zeitgeist of the time is very much MMT. It's very much social stability. And as we've seen many times, at least from a monetary perspective, temporary measures end up being anything but, right? Mm-hmm. So I'm just kind of curious what your thoughts are, going into kind of the rest of the year on fiscal policy from, the US, potentially maybe even kind of Europe. And then if you have maybe anything else to add on, the Fed and YCC in general.
Yeah, so with fiscal policy, they've done a lot of work last year. Globally, it's amazing how much fiscal stimulus we've had, probably more than we've had in the last 30 years.
Yeah, never seen, right? I think is fair to say. Yeah.
So I think that starts to fade after this 1.9 trillion. Because why did we need the fiscal policy last year, the stimulus? Individuals who were impacted, you had SMEs, some businesses that, were going to run out of, they just weren't making money. And so this was like a lifeline to this segment of the economy, right? So we need to pay unemployment checks, you need to give people loans which they can write off, etc., so that they can survive. Mm-hmm. As the economies open up, you don't need to give them that much of a lifeline, especially when the other part of the economy is really doing well. There will be some spillover effects. right? This pent-up spending. I think people have looked at personal savings rates now. They're like off the charts.
Yeah.
A lot of that's going to come into these sectors which have been affected, right? So I'd expect a recovery in this sector. And, maybe they don't need that fiscal help anymore, right? So I think in
And the
terms
pressure is definitely less, right? For the
Pressure's less.
politicians, right? Yeah.
correct, because
Yeah.
they'd be doing well. And,
Yeah.
people always talk about the fiscal cliff. I'm not so worried about that because I think the pickup in activity in these sectors is
Yeah.
going to more than offset that.
Gotcha.
But then you have the other side of government spending.
Yeah.
What do they want to spend on? EV, they've got all their agenda. So I think that part is going to be a bit tougher to push through. I think it'll take some time.
Yeah.
And I suspect, and I'm not sure the markets are prepared for this, that we're going to get tax hikes in the
Gotcha.
second half of the year.
Corporate, personal, both?
Personal is difficult
Yeah.
because I think you need a 60% majority in order
Yeah.
to get that kind of stuff through. Corporate's a bit easier, the way Trump did it the
Yeah.
last time around. So I wouldn't be surprised if we go from 21 to 25.
Yeah. And corporate's politically savvy as well for the
Correct.
Dems as well, right? Yeah.
And that helps to fund some of these green projects.
Gotcha.
I think 21 going back to 35 is not possible.
Gotcha.
But 21 to 25, a small jump,
Yeah.
that funds some of these green projects, I think that works.
Okay.
In terms of making money from fiscal, it really depends what they're doing. It's not as easy. Monetary stimulus is easy. You pump money into the markets, you buy anything. Right?
Yeah,
Asset
yeah,
prices
yeah.
just go up.
Yeah. Yeah.
With fiscal, you need to know where that money is going. So if they give it to you and me because and we are saving more,
Yeah.
maybe you want to look at consumption, discretionary stuff, right?
Yeah.
I think what they've noticed is that after the U.S. gives out a check, like let's say an unemployment check, 60% gets spent in a week.
Wow.
All right, I think Walmart sales go up like within that week.
Yeah.
Right. So
It's crazy because these are big ticket items for the average American.
Correct.
Right? So that's stunning that it goes that quickly. Right?
Yeah. And then
Walmart
if
sales go up.
exactly within a week.
Yeah. Yeah.
And if it goes to like to infrastructure, it goes to green stuff. Say they're pushing EV,
Yeah.
and you need more batteries, then you got to look at the commodities that are going to be supporting this battery supply, right?
Yeah. Yeah.
So I think you just have to be a bit more tactical when it comes to fiscal stimulus.
Sure.
Monetary, for me, it's a bit easier.
Okay.
Like it just lifts all assets because you're bringing down the expected your risk-free yield has gone down.
Yeah.
Right,
So
so
it's kind of math across the board. in a
Correct.
sense, Yeah. And on that point with monetary, like with the Fed, Yellen's obviously the new Treasury. Do you see some kind of new, dynamic kind of duo there, one way or another, or you think they'll just stay put as the economy kind of recovers and reopens?
I think they're actually playing a pretty good game
Yeah.
now.
In what way?
So the messaging is outright dovish, right?
Okay.
So what are they saying? They're saying like, I'm not even thinking about ending QE. The dots are telling you that they're not going to raise rates till 2024. But what's happening in the background? You're having a tightening of monetary conditions
What the
without
markets just basically do it, right?
markets doing.
Yeah.
And that's really good because, people, they've been quizzed over and over again. What are you going to do about financial stability risk?
Mm-hmm.
Powell keeps saying, I don't think there's a bubble. But what's he letting happen in the side? He's letting rates go up.
Yeah.
And what that does is it reduces stability risk, financial
Yeah.
stability risk, because it takes out the froth in the market.
Yeah.
So I actually think the Fed would be happy if 10-year yields were at 2%, not sad,
Okay.
right? Because then you get a bit of stability in the markets, right?
Gotcha.
There's less gambling, so to say.
Yeah. Yeah. Yeah.
So I think what they're doing now is pretty smart. By the end of Q2, I'm expecting the repricing to be complete.
Okay.
And that's why, when it comes to YCC, I think it's a discussion for the next downturn.
Yeah.
We're transitioning from monetary easing to monetary tightening. So YCC...
Still have a lot of fiscal kind of tailwind, right?
Correct.
Yeah.
So I don't think you're going to do YCC right now.
Yeah.
I think they're happy that the curve steepens. I think market forces will eventually buy the long end of the curve if we ever get close to 3%, so they don't have to worry.
Yeah.
And the next downturn, there's definitely going to be a debate again on whether you want negative rates or YCC. And I would imagine they'd lean towards YCC.
Gotcha. So the way I think I'm understanding this is still bearish on bonds. We got yields going up. There's reflation. Fed's going to stand on the side. And it pretty much goes to the underlying thesis that you're also saying we're seeing in the data that the it's hot and it's even going to get hotter once we reopen up, right? Before even needing to do anything or to tweak, right?
Yep.
And then we probably stabilize at some point around maybe, 10s definitely have to get above 2%, 30s probably above 275, and then there's just some natural mean reversion recalibration kind of factors, right? What would maybe need to happen for you to maybe, reverse that thesis, or at least go back and kind of question it? Like, what would you need to maybe see to rethink that?
I think two things.
Yeah.
The first would be on the virus front.
Okay.
Right. I mean, this whole thesis is based on global economies opening up, everything returning to normal. So if we get some variants which are resistant to the current set of vaccines, then we're going to run into issues. It means it just delays the reopening, right? So I think that would probably end the move in yields, right? Because that means the life support is back,
Yeah.
right? Fiscal,
Yeah.
monetary, everything is back, right? So I think that would put a stop to this transition where we're going from an economy that needs help to an economy that's running on its own 2 feet, right? The other thing, which I think is not a very low probability, is the Fed falling asleep at the wheel.
Okay.
Right. So imagine you had 8 to 10% growth this year. We're in December, and Powell says, "Yep, I still don't see inflation. So I'm keeping rates at 0, and I'm going to continue at 120 billion a month." And I personally am not in the inflation camp. Right?
Sure.
Because I think, one of the things we've seen in the last 12 months is tech adoption has been fast-tracked.
Yeah.
Right. And what does that lead to? A big jump in productivity.
Yeah.
And you can never underestimate how big a disinflationary force that is.
Correct.
Right. And I think it's going to pay dividends in the future.
Yeah.
But what's going to happen in the next 2 to 3 years is after this spike in inflation, it's probably going to stabilize at a nice level, maybe 2%.
Yeah.
Unemployment is not going to get back down to 4% because what has productivity done? Lots of jobs are going to be lost. There's going to be structural unemployment. And it'll take a while to retrain people to go from one industry to the other. So if the Fed is focused on inflation and unemployment getting back to pre-COVID levels, I think there is a chance they make a mistake and they just let the economy run too hot. And then you're going to get a big asset bubble.
Gotcha.
So these are the two things I'm looking at, is both ends of the spectrum.
Yeah, as just kind of a risk to the thesis kind of perspective.
Correct. Then that case, you just have to make sure you're ready for that bubble if it happens.
So maybe just two kind of points before we kind of wrap it up. Very hypothetically, obviously it's not your mandate, but if all the Dragon interview watchers put $100 together and gave it to you and said, but you could only put one trade on today, any asset class, any way you want to structure it, and we got to come back a year from now and see how that kind of did. So pretty tough, right? Because as we said, so many things can change in the dynamic. I'm curious, what would be kind of that trade or that position, or would you just, sit on cash, or how would you kind of treat that? Or
I'm pretty constructive on risk. I was waiting for this repricing in yields to happen.
Yeah.
So if I had to choose an asset right now, based on my view that inflation is going to be controlled and growth is going to pick up, you have to be long stocks.
Long stocks, right? So that's the path of least resistance, right?
Correct. It's going to be a volatile ride.
Yeah.
But as long as we don't get that, we don't have any problems on the vaccine front, on the virus.
Yeah.
I think we're setting up for a pretty good run second half of this year.
Okay, great.
Yeah.
I tend to echo kind of that. And I think, so stepping maybe away from the Fed, the US, I mean, we obviously talk about it because it's such a big effect on global macro, biggest market, biggest economy, et cetera. But whether it's EM, whether it's other developed markets, whether it's other asset classes, is there something else that's on your radar that you feel is maybe like underappreciated or is worth watching? So for instance, you and I were talking about this towards the back end of last year, where I think the divergences in monetary policy, i.e. getting more hawkish or less dovish, however you want to see it, they're going to come out of places like, Norway, Taiwan, obviously some kind of EM, and you've already seen, I think even Malaysia hiked at some point last year, right? So I'm just kind of curious if there's anything kind of like that you're watching that you think is interesting, that is still, for whatever reason, maybe not getting the proper attention it deserves. As you know, I've been a sterling bull for ages, taken forever for that thesis to play out. I've also been a Brazilian real bull for ages, and that's definitely not playing out. You've been dead right kind of there. So I think just from mixing it up, like, what else is kind of top of mind to you that you feel could be interesting to watch?
Yeah, I think the consensus is EM's going to do well,
Yeah.
dollar's going to sell off.
Yeah.
This is similar to what we've seen in like the early 2000s.
Yeah. And that's basically what was happening all towards the second half of last year, right?
Correct.
Yeah.
I think we're going into this episode of mini US exceptionalism again.
Yeah.
So, we've taken off our shorts on the dollar. I think with real rates going up in the US, this is not a good period for EM in general.
Yeah.
If you see yields in the US go up by more than 25 basis points in a month, it creates some issues.
Yeah.
It's gone up 70.
Yeah.
Right? So what has happened last year? Well, how has EM handled this? Because the US was very easy on monetary policy, they were cutting rates.
Yeah.
Right? The risk premium, the added yield you get for investing in a country like Brazil, for example, right? It's like 1.5%.
Yeah, it doesn't justify the risk.
Doesn't justify the risk, right? So that's where there's going to be a bit of repricing.
Mm-hmm.
We've seen that, you've seen the way some of these high-yielding EM currencies have sold off. I think that's going to continue in Q2. So I think that's a pain trade in the market right now.
Mm-hmm.
So I'm not as bullish about EM over this period.
Yeah.
But, it started with China. They first in, first out. US is going to lead it now. I think they'll grow more than China.
Yeah.
But that's going to probably shift to Europe and EM later part of this year.
Yeah, we're just seeing the baton being passed, basically,
correct.
right?
So, I think for me, I would shift my focus from the US to Europe and then eventually EM.
Gotcha.
So I think that you just have to embrace this period of US exceptionalism. It's not priced in yet. There's still some room for that to happen.
Yeah.
And then eventually we'll shift ourselves to EM and Europe.
Okay. And for closing, any thoughts on tail risk hedges that you kind of like, or anything else that you'd like to maybe leave people to kind of think about generally? Again, based on everything we know today.
Yeah, I think in terms of equity positioning, I think it's a bit better now compared to what it was last year. There's been a bit of a washout. Usually they don't drop very quickly. So even if there was a problem, the virus front or the vaccine front, I think you would have, it'll take some time. We saw what happened last year. It took a month before equities realized that.
Yeah,
right?
those issues.
Yeah, but because hedges are pretty expensive.
Yeah.
Right. My tail risk hedges, that sense, are really the front end of the curve moving further.
Okay.
And that could really cause some issues.
Because that's where the Fed would start to get worried, right?
Correct.
Yeah.
So I think if you need to be prepared for, instead of 2024, we start hiking middle of next year, right? If they let it overheat, because we don't know, right? This is the first time, we've had a big down move in the economy.
Correct.
And it's coming back really quickly.
Yeah.
And I get the sense the Fed's asleep at the wheel.
And I think the challenge that a lot of people don't appreciate is the deflationary, inflationary, the bounce, who's doing well, it's fragmented, right?
Yep.
So it's definitely not symmetrical to kind of society and to the players within society, which makes that job that much kind of tougher, I think, right?
Very tough. And, they're focused on this unemployment number.
Sure.
Right? No amount of monetary stimulus is going to fix that. If you keep focusing on that segment, which needs to come back, some might be on structural unemployment, but the rest of the economy is like firing on all cylinders.
Sure.
You're creating a crazy bubble there.
Yeah, exactly. At the cost of trying to get this.
And they can't fix it because it's structural, right?
Yeah, exactly.
So I think that's why when I told you 2 scenarios just now, I think the overheating part has a higher chance of playing out.
Yeah. Awesome. Ashvin, always a pleasure. Thanks for making time again.
Thanks for having me back.
Awesome.